Happy Thursday. This week's update, as you might imagine, is all about the Fed, but we do have a very, very good question to tee this up and to wrap us up for our Fed focus here this week from Nancy. Basically talking a little bit about inflation. What is it? Why it's important? How do we reduce the impacts? All that good stuff. So Nancy, thanks for sending that in, and we are going to bookmark our Fed conversation here today around this question. My name is Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue. And our goal every Thursday is to bring to you the market news, the data, the trends that we're watching, and hopefully weed out a bit of the noise along the way. So again, this week, we're going to change it up just a little bit. I'm still going to kind of bookmark this to some degree, but I do want to start by answering the core of this question of what is inflation. And then I'm going to finish after a lot of Fed updates, kind of wrapping up talking about how we handle inflation, ways to reduce the impacts, ways to invest around it, all that good stuff. So again, question from Nancy. Let's start with what is inflation in general? And I'm going to try and really simplify this because I think, unfortunately, with what's going on with the Fed is this has gotten overly complicated. And maybe the focus has turned to areas that aren't quite as directly impactful to inflation as the simple version I'm going to highlight here. So inflation, like many things, I would say is a supply and demand equation. And the most simple way I can put the definition of inflation is that there's just too much money and really not enough to buy. I'll kind of share a little bit of an example, right? If there is only $100 in the economy and only one pair of shoes, how much do you think that pair of shoes is going to cost? You could probably guess it probably is going to cost $100, right? If those are the only things out there, if we're going to exchange, it's probably going to be a swap, right? There's nothing else that you can do by keeping some money back for yourself because there's nothing else out there to buy. Let's say rather than $100, there is now $125 in the economy. You probably get why I changed this up because this is kind of what's happened lately. But let's say $125 in the economy and still only one pair of shoes. How much do you think that pair of shoes is going to cost? Now, it may not happen overnight, right? We may not all of a sudden see that pair of shoes cost $125, but over time, as things exchange, it's going to end up costing $125 because there's nothing else to exchange. Now, again, this is very, very oversimplified. There's a lot more going on in the economy, but I wanted to simplify this answer to put this in perspective a little bit and kind of like try and weed out some of the noise of what seems to be being addressed a lot by the Fed conversations here. All right, so we'll come back to that, but to highlight this week, the Fed meeting on Tuesday, or a couple days here this week, and then the Fed decision followed by the press conference yesterday, led to some market turbulence, let's put it that way. The Fed decided they are not changing rates, no surprise there, and basically suggested there's going to be another 25 basis point hike at some point this year. Now, obviously, they still said they're going to wait and see. They're going to see what happens. They're going to take the data as it comes. But that is kind of what the general consensus is at this point. Now, the interesting thing is that this really is no change. The Fed has been sharing this kind of message for quite some time. Yet yesterday, after the news, the market pulled back a pretty good amount. And here we are today on Thursday with the markets down a good amount as well. So unfortunately, I think that markets have been kind of calling the Fed's bluff, and maybe this was the reckoning of people starting to believe that the Fed is actually going to do what they say. Obviously, who knows is the reality. We'll see what happens in the data that comes between now and the next Fed meeting. But as a heads up, there are still 2 more Fed meetings before the end of the year, and it's likely that we may see one of those meetings with a hike. Okay. Secondly, they did also take off a few rate cuts in 2024. So that was kind of interesting to see. But as a result of this, we saw the 2-year, the 10-year, the 30-year, you name it, all yields spiked, and all indexes, NASDAQ, Dow, S&P, you name it, dropped on the news. I don't think it's, I don't think it's much of a surprise. In fact, I would say this is why it's important to have a little risk management in place right now, because it seems like things are kind of priced for a Goldilocks type of scenario. And if we can't quite figure that out, you could see a little bit of volatility here still to come. So Very interesting. I think in light of all that, as we kind of break down the press conference, there was some interesting comments. He had mentioned a few times that they're, excited about how far they've come. He said, basically, what did he say? They're holding in light of how far they've come. There was a lot of conversation around the impact that they've made on inflation. But, again, if we look at the most recent print, inflation is still here. Now, it's definitely come down to some degree, don't get me wrong, but it's definitely much, much higher than the 2% target that they're aiming for. So I think this is why it's very likely we may still see a hike before year end as well. It was also interesting. He started pointing a little bit more to headline inflation. We all know that typically he talks about core inflation, but he was pointing to headline inflation, kind of suggesting that prior to this most recent one anyways, that these numbers are coming down. He honestly kind of suggested that inflation was not going to be persistent still, although we've seen that it certainly has been. So kind of dying on that sword, I guess. But nonetheless, he's seeing labor market increases, inflation easing. There was a lot of conversation around that. So they apparently feel like they are heading in the right direction. I think it's very clear they don't feel like their job is done, hopefully. But they do feel like they're heading in the right direction. I think it was very clear from the press conference that followed the decision there. Again, 2 more meetings this year. I'm hoping that at some point we start talking about this great question from Nancy, which is about the money supply, because the interest rate hike certainly can have an impact as they slow the economy down to some degree. But the money supply is really what I think is driving this potential slowdown in inflation growth. But we still have a lot of ways to go, obviously, too. So coming back to the question again, what is inflation? Again, I would suggest that it is exactly what I had shared earlier. It is too much money and not enough to buy with that money. But let's kind of break that apart a little further. So the part 2 and 3 of this question is maybe what are some strategies consumers can use to handle inflation? So I'll start there. And, to be honest with you, from a consumer perspective, this is the challenge with inflation, is there's not a whole lot you can do. It's kind of hard to hide from inflation when it starts running at these levels. We've all probably felt our expenses increase over the last year and a half here. And I don't know that I have a whole lot that you can implement to reduce that impact. I would say that there's some things to consider. You may want to stock up, for instance, to help with any short-term spikes in price increases. We saw like eggs, for instance, 6 months ago, maybe, where they just skyrocketed. If you had some extra and didn't have to buy some eggs at that point, that might have helped. Oil obviously is very volatile, and food as well. And so if you can kind of stock up on some of those things, if you can, may help a little bit with short-term spikes. Separately, it's important to maybe keep a bit of an emergency fund as usual anyways, just to keep a little cushion. Big thing I would suggest is that you also want to make sure that the cash that you do have is in a high yield savings or a CD or something that's getting a little bit more than the traditional bank savings rates, because right now cash is paying at a decent clip. And then, if need be, if none of this works and things are still really, really tight, obviously you may need to focus a little bit on the lovely B word in finance, the budget, right? Maybe focus a little more on spending than you might typically. Part 3 of this question was areas to consider for investments. And here what I would suggest is you may want to look outside of traditional aspects. Now, staples, for instance, can be a good place, right? People still do need food, whether or not it costs, right? People were still buying eggs when it was expensive. You may also, like real estate can be a good place to look. Now, there may be some challenges now in that arena. Commodities can be a good place to look in general when inflation runs higher. Again, as you might imagine, goods end up costing more. So hopefully that's helpful. Those are some areas to kind of focus on. But again, it depends on where we're at in this inflation cycle as well. So commodities last year were very strong. This year, it's been stable, but nothing too exciting. So just take that in with a bit of a grain of salt. These are generally areas you can look, but depending on where you're at in the cycle may dictate, whether or not it's important to explore that too much further. So thank you so much, Nancy, for the question of the week. Be sure to tune in next week. We'll see you next Thursday at 3. We're going to talk a little bit about, we actually have the next inflation print coming out, so we'll be spending time on there, and then GDP revision and housing and jobs data. Thanks so much for tuning in this week. Hopefully this is helpful. Very good conversation around the Fed and inflation. And we will see you next Thursday at 3.